Welcome to The Explainer. Have you ever wondered how professional investors actually analyze a company? Well, today, we're going to pull back the curtain. We're going to deconstruct a real-world analysis of a tech company called NETSOL. By the end of this, you're going to have a fantastic framework for how to think about any stock, not just this one.
So here's our game plan. First, we're going to figure out what NETSOL is all about. Then we'll look at the good stuff, the bull case. And then we'll flip it and look at the red flags. After that, we'll see how a pro analyst actually scores all this, and we'll wrap it all up with a practical guide for you.
All right, let's dive right in. First things first, who is NETSOL Technologies, and what exactly do they do?
At its heart, NETSOL is a software company based in Pakistan. But here's the key. Its business is global. A huge chunk of their money comes from clients all over the world, which makes them a really important player in Pakistan's IT export scene. And that's a big deal, because bringing in foreign currency is crucial for the country's economy. Okay, to put a number on it, this is what one single share of NETSOL was trading for back in mid-February 2026. Just kind of keep that number in the back of your mind as we dig into how the company's actually doing. Now that we know who they are, let's get to the exciting part. Why would an investor look at this company and get excited? This is what we call the bull case, all the reasons to be optimistic. And the very first thing that just jumps right off the page is this incredible revenue growth. A 52% increase in just 2 years, that is a massive signal that there is strong demand for what they're selling. This isn't just a small bump, it's some serious expansion. But, making sales is only one part of the story. The real question is, how much of that money do they get to keep? And this is where NETSOL looks pretty strong. A gross margin of almost 40% is really healthy, and that net margin of over 11%, that shows that even after you pay for everything else, there's still a nice slice of profit left over. For the tech world, those are solid numbers. So on top of that amazing growth and solid profit, you look under the hood and see the foundation is rock solid. They've got more cash than debt, which is always great to see. They have a pipeline of over $21 million in sales already signed and waiting. The government is giving them a nice tailwind with tax breaks. And the cherry on top, the stock isn't ridiculously expensive compared to its earnings. That's a really attractive picture. Okay, but any good investor knows you can't just fall in love with the good news. You have to turn the coin over and look at the risks. No company is perfect, so let's dive into the bear case for NETSOL. And this chart, wow, this highlights the biggest concern right here. The company's earnings per share, basically the profit they make for every single share you own, dropped by 25% in the last fiscal year. That is a major red flag, and it's something we have to understand. And the problem isn't just that the earnings dropped, it's how unpredictable they are. The analyst report calls their quarterly results volatile, and what that means is their performance can swing like a pendulum from one quarter to the next. That kind of roller coaster ride can make a lot of investors really, really nervous. And the worries don't stop there. Their profit margins have been getting squeezed, and because they're an exporter, they're super sensitive to what's happening in the global economy. Plus, a lot of their business comes from just a few big customers, so if one big project gets delayed, it can really hurt their numbers. Oh, and if you're looking for steady income, this probably isn't the stock for you. The dividend is pretty low. So, we've got this classic dilemma, right? A company with a ton of long-term potential, but some pretty big short-term problems. So how does a professional analyst make sense of all this? Well, they use a system, a scorecard, to weigh all the pros and cons. This scorecard is so cool because it really shows you how an analyst thinks. You can see they love the policy environment. That gets a high score because of government support. But then they're a lot more cautious on the fundamentals because of that recent earnings drop. It all adds up to a final score of 62 out of 100, which is still a buy, but it's not a screaming, pound-the-table kind of buy. It's more of a cautious thumbs up. So here it is, the whole story in a nutshell. It's a real tug of war. On one side, you've got the bulls who are fired up about the growth, the strong finances, and the future sales. And on the other side, you've got the bears who are pointing at that drop in earnings, the unpredictable results, and shrinking profits. This is the central conflict every single investor has to wrestle with here. Okay, so after all of that, what's the takeaway for you? If you're thinking about investing, what's the actual game plan? Let's check out the analyst's advice. The analyst lays out a really smart 3-step plan. First, don't bet the farm on this. Treat it like a satellite holding, a smaller piece of your overall portfolio, maybe 3 to 7%. Second, you've got to watch this thing like a hawk. Keep your eyes glued to 3 key things: revenue, profit margins, and cash flow. And finally, Try to use that wild up and down nature of the stock to your advantage. If the long-term story still looks good, a price dip could actually be a buying opportunity.
And that really brings us to the one question that matters most, the question you have to answer for yourself. Is this recent trouble just a temporary speed bump for a great long-term company, or is it a warning sign of a much deeper problem? The answer to that question is everything.